Hello traders and investors, Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a good Friday session, a good weekend, and a good Monday session as well, because I haven't seen you guys for a while. So where exactly has Will been? Well, of course you guys know I'm traveling right now, but I spent the past 5 days touring some very nice ancient temples, guys. I'm a bit of a history nut. I love archaeological sites. This is me at Angkor Wat in Cambodia, a complex. There's about 10 square kilometers of temples like this, dozens and dozens of them. So I've been having a lot of fun exploring all of them. And then during the weekend, I actually had to take a 36-hour layover towards Thailand to close some deals on a property that I'm exploring there as well. And now we're kind of back in Cambodia. So I've been all over the place. But why are you talking about us? Why are you talking to us about your travels? Enough about the temples, enough about your penchant for history. Let's get into the markets. Tell us what's happening. Is it the end of the bull market? Is everything crashing and burning? Should we be selling all our stocks, or is it just a lot of volatility from the same fears that we've been seeing over the past few weeks, coupled with the infamous rotation away from tech, away from large cap growth into value and into second phase AI trades? So we're going to talk about all that in today's video, as the most recent days have been very volatile and I haven't seen you guys from a while. Of course, there was the Friday session in which the Supreme Court struck down Trump's tariffs, but Trump, always having different cards up his sleeve, will be resorting to other various sections to keep those tariffs implemented. We'll talk about the tariff situation. We'll also talk about what happened yesterday in the markets, another day of fearful AI sell-offs, this time sparked by a Citrini report. Citrini, one of the top contributors on Substack, has a ton of followers on Twitter, and his article was quoted by most of the mainstream media outlets. So it did make the rounds, and it did spook a lot of people. We'll talk about that article as well, and then we'll get into today's price action too, which saw a bit of a rally recovery. All that drama over the past few days to do absolutely nothing on the QQQs, and additionally, absolutely nothing on the good old S&P 500 other than shake up the markets a little bit, rile people's feathers a little bit too. So in today's video, we're going to recap it all for you guys in as timely of a manner as possible, catching up the last few days of trade. So first part of the video, we'll be taking a look at some of the news catalysts, everything from Friday, from the tariffs to yesterday's Citrini report, to a few interesting statistics that are circulating around the markets right now. So we'll be taking a good 15-20 minutes of the early portion of the video to talk about everything that's happened and to put everything into context and provide some news insights as well. After that, we'll be going over our technical analysis portion of the video, the SPY, the Qs, our indexes first, taking a look at the rotation, taking a look at the market breadth. Are the markets still healthy, or should we be selling absolutely everything? Because we know there's a lot of current bearish narratives in the market right now, which we highlighted last time I saw you guys on Thursday, but we do also have a lot of bullish tailwinds for 2026. So we'll be taking a look at the indexes and a bit of the rotation therein. Thereafter, we will take a look at our big tech name list down here, and once again, after a lot of these tech names reported earnings and came down significantly, are they currently good buys? Even though a lot of these companies are spending tremendous amounts of free cash flow in the pursuit of more and more AI and more data centers, are they still good buys? Or should we be staying away for now, possibly waiting for more suitable uptrends to enter? And then towards the very end of the video, we'll be taking a look at our biggest gainers and losers of the day. Now, of course, this list has shifted around many times on Friday, on Monday yesterday with the big disaster, and then today again. So rather than going over individual names, once again, what I'll be doing, similar to last Thursday, is going over a few key themes. And within those key themes, some of my favorite names that I'll be focusing on here as we enter into the back end of good old Q1 in our good old financial markets. So it should be a very fun and interesting video, a video where I touch base with you guys. Hopefully you guys have been well, of course. Now, without further ado, let's jump right into the action, shall we? So the S&P and the QQQs haven't really moved in the last few days, but it's been super volatile. The VIX, as a matter of fact, still around the 20 range, right? So the S&P up 0.75% today, the Q's up just over 1%, but we know it was very wild price action over the last few days. To sum it all up here, in terms of the heat map, today at least, nice rally recovery from a lot of your big tech names. Now, big tech got smashed in yesterday's trade, but they did have a good performance on Friday, and a lot of these names haven't really moved that much if you compare with where we left off together last Thursday. So, decent day of performance by big tech. Financials still remains a little bit weak, and yesterday they really got hit hard with the Citrini article. So, we'll take a look at a few financials names today and derive whether or not they're still good buying opportunities, such as the banks, such as the credit cards as well, but financials mounting a bit of a recovery today. Healthcare remains a little bit mixed. Your market leader there, Eli Lilly, down a little bit, but Novo Nordisk got absolutely destroyed yesterday after their trial results came in a little bit underwhelming, and Eli Lilly just remains the king of the entire weight loss space. And the bottom half of the market continuing to see very decent rotations, everything from defensives, industrials, utilities, real estate, energy, basic materials. They've been performing very well. And as a matter of fact, I will just remind you again, we covered this on Thursday and many times to start off the year, but it's the game of rotation, right? Bottom half of the market has been leading the way for many different reasons that we've previously described. They've caught a little bit of a fear bid recently, but this rotation has been underway now for the last few months, right? They have gotten a little bit more rotation because of the fearful nature surrounding growth and AI and all that good stuff, the sentiment-driven sell-offs that's been affecting the top quadrant of the market. However, this all started because the macro outlook for 2026 was much better than we had in 2024 and 2025 in terms of the visibility on interest rates, on inflation, on additionally, right, the end of quantitative tightening, all the bullish macro catalysts that we've been talking about, very decent GDP numbers, although last week they came in a bit underwhelming, but Q1 should be strong. And then you obviously had very strong earnings and the massive fiscal stimulus and the $4 trillion worth of tax cuts. So the rotation started off because of better visibility on macro, but then continued because of the fear bid surrounding AI. So in terms of your one-day relative performance now, you can see that today was a very decent day of broad market recovery, only healthcare getting a little bit left behind, but today obviously is just a reflection of a bounce recovery. So the 1 week relative performance with all the volatility shows a better picture in which you will see that the best performing sectors are the same ones that have been really performing well this entire year so far. Materials, energy, communication services, defensives, and utilities are leading the board, with financials down a considerable amount. 1 month relative shows the exact same picture, and overall the year-to-date performance will show you the exact same thing, to where materials are leading the way. Look at these performances, guys. Year-to-date, materials 24%, energy 21%, industrials 15%, defensives 15%, and utilities up a whopping 10%. Now, obviously, within these, you have some big outperformers, right? We can talk about the year-to-date returns of a lot of these companies. SanDisk to Texas Pacific Land Corporation up massively. Corning, which obviously got that big contract with Meta, doing glass and fiber optics, etc. Generac and Caterpillar doing very well with their generators for data center purposes too, of course. You got Moderna, you got Teradyne, you got Comfort Systems, a construction company basically specializing in HVAC systems, especially large commercial applications, which is why a lot of these themes have been working well with the data center building, right? Not so much the actual hyperscalers themselves, not so much the application software layer of the AI trade, right? But what's been working well is everything inside the data center, or everything that powers the actual data center. Those have been the key themes over the course of the start of the year, at least closely tied to AI. Obviously, we can talk about the military themes, and you will notice many military names on the highs, right, for the year. Lockheed Martin, Raytheon, and a number of other ones doing very well. But you can see also here GE Vernova, Quanta Services, GE Vernova with the big gas turbines, Quanta Services with more construction for data centers, obviously. So you'll notice that a lot of the best winners of the year so far are anything inside the data center, whether those are semiconductors themselves or semiconductor equipment or construction companies or cooling companies or thermal processing companies like VRT, or many things of that nature, right? We called this the phase 2 of the AI trade, which we were referencing late last December and early January as one of our favorite themes on the channel coming into 2026, and so far so good. And obviously, to the complete flip side, you got all the way down here. I mean, the companies that have just been doing terribly this entire year. Everything software, everything that's possibly in the target of any Claude release, any Gemini release, right? Whenever they release new plugins, new tools, because now we are no longer in the chatbot phase of AI. We are now in the agentic AI phase. So AI agents that are able to replicate many different things. You just give them a task and they'll be able to basically do it, right? Or you give them the task of possibly making a platform or a software service that looks like Salesforce or that looks like something, right? Obviously, it's not going to have the distribution. It's not going to have as many features. There will be bugs. There will be hallucinations. But just the premise that AI is now able to replicate a lot of this stuff has many people spooked. And we know the short sellers and the algorithms have been going absolutely wild on the tape, sending some of these down in record fashion, snap as soon as the news release is posted. So you know it's not retail, right? Retail's not at their computers every second of the day waiting for the new COD release and then seeing companies like CrowdStrike go down 10%, IBM going down 10% initially on a 2-minute candle, right? That's not what's at play right here. What's at play is the sentiment is so bad across many of these names that whenever there's an article like that, there's a lot of algorithms that just jump on the trade and there is nobody there to take the other side of that trade in terms of buying, because right now there's a lot of uncertainty, right, between the various narratives. And we'll talk about the narratives right about now when we get into what happened yesterday with the Citrini article and everything like that, right? So before we get into any technicals or more talks about rotation and whatnot, let's talk about the news timeline that's transpired over the last few days. Of course, on Friday, you had the Supreme Court striking down the legality of Trump's tariffs, but we know that he was using the Emergency Powers Act to enable all of those tariffs. The Supreme Court said, no, you can't really use that act specifically for the tariffs. A president should not be allowed to use it for those reasons, right? Unless there is a true threat to actual national security, right? Now, Trump argues that there was. The Supreme Court says, no, there wasn't. So you have to take the Supreme Court's decision at face value. But we also know that Trump had been quoted in saying, and also Mr. Hegseth and Mr. Besant and Mr. Lutnick were also saying that in the event that the Supreme Court would rule unfavorably towards the tariffs that were deployed with the Emergency Powers Act, well, there were many other sections that you can apply these tariffs to have them maintained, which is why on Friday you got a bit of a relief rally, right? Because the market anticipated that possibly it would be the end of the tariffs, although it does come with a big mess in terms of, are they going to have to repay all the money from the foreign direct investment? Because we know that a lot of those tariffs were then used to broker different deals with different countries, Japan, Korea, a lot of the Arabic countries as well, investing heavily into American either AI or manufacturing processes or infrastructure. We also know that Europe committed to $700 billion of natural gas, many things of that nature, right? Were they going to be sent back? Was Trump going to have to refund everybody? Well, not so fast. The Trump tariffs will be maintained right now at a rate of 10% using various other sections under which you can implement tariffs. And at the same time, a bit later that day, or I believe it was Saturday, Trump thereafter said that, you know what, we're going to increase them from 10, which is the baseline now, to 15. Although the 15% has not come into effect. So, Trump coming in and possibly using the negative catalyst to just reiterate, no, the tariffs are not only staying, but we possibly will do more. I'm just recapping all the news very quickly because I haven't seen you guys, right? So he said over the weekend that they would start at 15%. Now they're going to be using different sections, such as Section 122, where tariffs of up to 15% can be quickly applied, but only up to 150 days overall, which would put you pretty much through a better part of this year entirely. Now, moving on further, the global tariff will start at 10%, but the administration is working on raising it to 15 in a separate order that Trump will need to sign. The official did not have a timeline for when that would occur. So the 15% is still on the table. It hasn't been signed into effect, but the 10% is definitely live right now, which is just maintained from what it was last year. So arguably, nothing's really changed in the tariff story, which led us into the Monday price action, which was a big red disaster. And if you're not paying attention, if you're not locked into the markets, as they say, as someone like me who spends, so many hours per day, you might have thought that Monday's price action, the big decline, was because of this highlight right here, the tariffs. Well, as a matter of fact, no, it was not. It was because of this right here, the good old Citrini Substack sell-off. Now, if you don't know who the Citrini Research Group is, they're pretty much the top Substack ranked author on the platform, right? And they do have a Twitter account, pretty large Twitter account here with about 175,000 followers. And this article was released over the course of the weekend. Spent over 100 hours over the past week researching, writing, and editing the piece that he just put out. And the framework of it was a thought experiment. And that's how the entire article was positioned, right? Just, it's a scenario, as they said, not a prediction like most of our work, but they went through a bit of a thought process, a thought construction analysis, and kind of projected what the world could look like in the event that AI proves to be extremely efficient and does do what many people fear that it will do, such as displacing a large portion of the jobs market, which then could have a lot of people laid off, which would then translate to lower economic output because people lose their jobs, aren't able to spend as much, right? Basically putting you in a great big AI doom loop. And although today we're not going to spend a tremendous amount of time talking about the article, you need to research this one on your own, right? Because it's a good thought experiment. It's a very well put together article, very well researched, and they did highlight a few companies that were under the gun in the article, which then dropped to tremendous fashion yesterday, such as American Express, DoorDash, for various different reasons, which I may touch upon here in a few moments. But I want to show you this loop, right? This is the loop that had everybody nervous yesterday, which is why there was just indiscriminate selling again across the board, as if all the Claude and Gemini releases were not enough to crash software stocks, which they were, right? This report just sent them down for another wave of selling right here. And it just basically goes like this, right? AI investment increases and AI capability improves. Companies as such need fewer workers, which we've talked about many times together. White collar layoffs increase. Displaced workers spend less. The economy weakens. And as a result of the economy weakening, companies in search of looking to protect their profits, well, they just invest more into AI to protect those profit margins, and it just keeps going, right, in this inevitable doom loop, and in which they predicted, you know, in 2028, we might be having 10% unemployment, right? And that was the kind of gist of the article overall. Now, they did highlight a few different scenarios in terms of, you know, all about friction in terms of what the consumer preferences would possibly be, right? So here they talk about how payment rails are changing. This is just basically the stablecoin thesis surrounding credit cards, which we've talked about many times on the channel in 2025, to where, you know, everybody knows that Visa and MasterCard and American Express take a small little fraction of every payment, and it's not the most efficient, nor for the merchant, arguably not for the payment network as a whole, as you do pay more transaction fees than would be necessary with stable coins, right? So you can see agentic stablecoin transactions. If you were to send all the payments through AI agents, well, they would obviously choose the most efficient ways of making those payments, and they would opt for stable coins, right? So the agent would route the payment through USDC networks on Solana or a layer 2 network of Ethereum, and the total cost would be about a penny, which would leave more money in the pockets of merchants, and obviously there would be less overall drain in terms of just fees overall in that same transaction, as of where right now you got a $100 consumer purchase, then there's a merchant fee, then there's an issuing bank fee, a network fee, an acquiring bank, and a processing fee as well, to where the merchant only receives $97.50. And that was enough because they named Visa and they named MasterCard by name, and they named American Express by name as well. That was enough to drop those companies in a ridiculous fashion yesterday. I mean, American Express, you can see, right? They were down like 7% on the news. Visa, MasterCard, they were down like 6% on the news, right? Just from that article alone. Okay. And yes, it was from that article alone, guys. This article was quoted by everybody. It was quoted by CNBC many times throughout the day, and other legacy media. It was quoted by Bloomberg. It was also quoted by the Wall Street Journal, which is what we obviously showed there in the first screenshot. So it did make the rounds. And to be honest with you guys, just got to think for 2 seconds, right? Do you really believe that yesterday there were very large firms and large retail players selling Visa and MasterCard before even getting a sense of what the article had to say? No, right? A lot of algorithmic selling from firms like Citadel, Jane Street, etc., with a lot of predatory activity on the books. And that's nothing new. We've been talking about that for the last month and a half. They have free reign right now because people are hesitant to buy these dips because there's a lot of fear and a lot of uncertainty around what will be the long-term implications of AI. And this was just another one, right? But the one thing you need to understand from all this is these are 2 different reasons for conducting a payment, right? One, in this case, would argue that the AI agent is just seeking to make the most cost-effective transaction, but that's not why people use credit cards. Stablecoins don't offer consumers credit, nor do they offer them fraud prevention, insurance, rewards programs, and so many other things that come with credit cards. They're 2 completely different products. Nobody's arguing that the stablecoin networks are faster and more efficient and cheaper, but that's not the point of why people use credit cards to begin with, right? It's really 2 completely different things. And this is highlighted in the article as well, but the algorithms being the algorithms, they'll just sell things off regardless. It's the same thing. DoorDash and Uber were mentioned a bit earlier in the article, saying saying that once again, AI agents will try to take the path of the highest efficiency, right? Saving you, the consumer, much time on apps, many clicks, and a lot of friction was their word that they've been using, right? To where you can tell an AI agent, well, just get me a pizza, and it's going to find you the cheapest pizza, right, in the neighborhood for the fastest delivery time. It's optimizing for speed and for cost, right? But that's not where consumer preferences lie. You, as a consumer, right, you may want to go for your favorite restaurant, or when you're grocery shopping, you may not want to have the most, cost-effective product or whatnot. You may like one brand specifically, either a food brand or a beauty product or things of that nature, right? So consumer preferences are not only oriented surrounding cost and a speed of delivery of the product to you, right? There's many other brand preferences that come into play. So obviously, this article just doesn't go over all of those. It only paints the picture that AI agents are far more efficient at making transactions than you or I would be in terms of product research, to then buying the product, to then shipping the product to your house. But it may not actually be the product that you truly want or that you would truly enjoy. But it was enough yesterday to crash the entire markets. Now, moving on further here, we had some pushbacks from other analysts. One economist right here, Alex Imas, Citrini actually said they would want to see this article be challenged and want to see competing points of view. And so other people responded. This economist right here, Alex Imas, put together a phenomenal Substack. We're not going to go over it all today, but you should definitely have a look if you're interested here. An economist, and he actually did the math, all together in a very, 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 very extensive piece of counter research. And he basically said for the conditions that you would need for what the essay describes to actually happens. You need fairly implausible conditions on both what happens to investment and preferences, basically to cause the doom loop and the massive layoffs and the 10% unemployment. And obviously, the headline of the article from Citrini is, in June 2028, the S&P is down 38% from its highs. Unemployment just printed 10%. Private credit is unraveling. Prime mortgages are crashing. AI didn't disappoint. It exceeded every expectation. So Alex Imas in here with the math and kind of saying, no, you would need pretty wild assumptions to actually make that happen. And you obviously had other people, such as another very famous person on Twitter who runs the Kobisi letter, right, writing a very interesting piece of its own, saying it's too obvious. What if AI actually doesn't end the world? And also presenting some very interesting counterpoints, and also referencing, how skittish the markets are right now, how fragile they are in terms of whenever Claude releases something, Gemini releases something, it's just snap, instant selling from the algorithms overall. A lot of manipulation, a lot of predatory trading practices right now, but they have the sentiment, they have the narrative, and people are just not taking the other sides of those trades as frequently as you may have had without all this AI uncertainty, which is why they're able to just destroy these companies, and people are just not willing or able to buy the dip with as much volume as these long-short hedge funds and the HFT firms are able to deliver in terms of just the order flow on a daily basis, right? So keep that in mind. You'll notice he references the chart right here. February 20th, 1 p.m., Claude announces Claude Code security. And literally in, the next few minutes, they're already down 10%, right? And here we go. CrowdStrike erases another batch after they were also called out in the Citrini article. So just back-to-back destructions of billions and billions of dollars in market cap from these articles, from these just sentiment sell-off surrounding AI, right? And now what's funny about everything is that Citrini actually saying, just for the record, my portfolio is 90% net long right now, LOL. So that's obviously very humorous. So that's everything in terms of that whole aspect of the market. Once again, you had one piece of news yesterday from Anthropic again, just previously, right, in terms of IBM this time, saying Anthropic was announcing that Claude can streamline COBOL code. However, it was literally just a blog post. No plugin, no formal product to speak of, no demonstration, nothing. Just Claude saying that it can read COBOL code. That was enough. Look at the algo moves on IBM, right? I guarantee you no single investor, no institution was looking at the tape at that time and saying, oh yeah, it's time for us to massively liquidate IBM positions. No, obviously predatory trading practices right here, right? A lot of leverage involved in these shorts as well. If there's nobody there to pick up the other side, they just destroy companies left, right, and center, right? Very, very, very nasty game that Wall Street can play sometimes, but it is what it is, right? It's becoming increasingly clear how pivotal the times we are right now. And that being said, moving on further, it's funny? This guy highlighted too. IBM was down 11% on Anthropic's COBOL tool. Never mind that Amazon announced the same thing in December 2024. And then he basically said markets are the R word, essentially, right? So that was obviously very funny. COBOL is a legacy code system that not many people use anymore, but a lot of the banking practices were, or a lot of the banking systems were built on it. ATM transactions, payment processing systems, and many other things. It's kind of an old, archaic model and language, if you will. AWS has had it in terms of being able to do it for a while, but since everybody's paying attention to every single Claude release, well, the Claude release is the one that obviously sends it down 10%, right? So a very fragile market environment right now, guys. I'm pretty sure you guys are used to it by now because we've been talking about it almost every single day for the past month. It's nothing new here, right? It's a product of the sentiment and the uncertainty surrounding the AI trade right now. The fact that we talked about the paradox of AI right now, right? AI is both somehow in a bubble, which is some people say, but also so powerful that it's just going to destroy absolutely everything in the entire planet, at least everything that's any company that's ever used the internet, right? So those are two very mutually exclusive things. They can't both be true. AI can't be both damaging itself, but also damaging everything else in its path. Right? Moving on a bit further, just goes to show you how irrational the market can be sometimes. And once again, we've talked about this many times on the channel, right? Moving on here further, we already covered that right there. Now, we're going to talk about some statistics in the market after all this has happened. We know that tech, software, all those good things have been unfavorable. We've talked about the rotation, the obvious rotation into the bottom half of the market, which leaves you with some curious valuation polls right now, right? So moving on right now, the forward PE of the tech sector is now at par with consumer staples. That's only happened 3 times in the last 7 years: COVID, the 2022 bear market, and Liberation Day. So essentially what the market is telling you now is that things are as bad as they were in Liberation Day, when some countries had 100% tariff rates, massive economic uncertainty. Whether there could be more inflation? Was the Fed going to increase interest rates? How's the job market going to stand upright? Way more macro uncertainty than you would assume there is right now. 2022, I'll remind you what style of market that was. That was a style of market where you had record amounts of inflation, something you haven't seen since the 1980s. The Fed was embarking on their fastest path of interest rate hikes in the last 20 plus years. And additionally, supply chains were just absolutely broken as people were still contending with the aftermath of the COVID pandemic. That was 2022. Massive macro uncertainty. And 2020, I mean, do I even need to describe what 2020 was? Massive global pandemic, shutdowns all over the place, curfews all over the place, just massive amounts of uncertainty. So of course, tech and growth is going to sell off, right? But right now, what the market is telling you is that there's as much uncertainty in tech as there was in those 3 previous conditions with massive amounts of macro uncertainty. I don't think that there's that much uncertainty. Is there uncertainty right now? Of course there is. But as much as the Liberation Day with massive amounts of tariffs, or 2022, or the global pandemic of 2020, debatable, right? Very, very debatable. Just something to pay attention to, which may lead us to believe that, well, maybe this is starting to get really overdone, right? And we may be approaching the last leg of the violent, volatile sell-offs. It doesn't mean that some of these companies won't stay down and take a while to recover, right? It just means at the end of the big volatility, the big crushes, the big flushes, the shoot first and ask questions later, that phase of the sell-off may be nearing its end as your price to earnings ratios are really normalizing to historical levels where they truly do traditionally find a bottom, especially when they line up with the value segment of the market. Moving on a little bit further here, moving on to some gold headlines. China's never had so much gold. China gold reserves surging 15% month over month in January. We know that last week it was Chinese New Year, so a lot of the Chinese markets were shut down, so they obviously weren't participating as much in the gold markets. Now that they're reopened, gold is getting a bit of a push. Look at this right here. Massive gold reserves, not only for China, but also for many central banks surrounding the world. And as a result, gold still remains a very popular trade and in a secular bull market for the time being. So we'll talk about gold a bit later, but very interesting statistic as well. Moving on a little bit further here as well, AI-driven investments are making historic contributions to U.S. economic growth. We know that already. The contribution of computers and peripheral equipment to real Q4 GDP surged to 57.57 percentage points, the highest in history. Look at this. U.S. contribution to real GDP growth, private fixed investments in computers and peripheral equipment, right? So we know the infrastructure build out in terms of data centers and whatnot will contribute a lot to the increase in GDP. But there is one big bottleneck coming in the future. That's going to be energy. So there will be a lot of money spent building up energy infrastructure in the next few years as well. So you could expect very bullish GDP prints in the near-term horizon as well. Now, are consumers still a little bit flat? Yes, of course, and we know that it is a high consumption-based economy, but it does help when you do have a lot of, government spending power into a lot of different things and a lot of private investment. As we know, the multiple components of GDP are indeed just those, right? It's consumers, it's private investment, and it's obviously government spending too. And as long as private investment and government spending do remain high in the sectors that matter the most, the consumer is on a slow path to recovery overall. So overall, everything is contributing to GDP. It's just consumers are not contributing as much as they once were at the current stage, as they're still battling the aftermath of the high inflation. But as we've been measuring over the course of the most recent data releases, consumer spending power and personal income is recovering more and more against the current rate of inflation. So moving on a little bit further, a couple more for you. International equity funds. We talked about this last week a lot. They were attracting $17 billion in net inflows last week, the highest, second highest on record, more than double the average seen in 2025. Here are your biggest 4-week inflows to global equity funds. As you'll notice right here, right? Very, very strong, extremely strong inflows in terms of international. Now, that being said here, guys, right? You got a lot of very potent trades underway right now. Obviously, we talked last week about the Korea trade, EWY, very, very strong because SK Hynix and Samsung represent about 45% of that index. And they are, quote unquote, deeply undervalued. And their projections through 2027, 2028 are very strong. That's been very good. Japan has also been very strong to start off the year so far too. We can also look at another popular one that's been brought up recently, which is large cap from Brazil, EWZ, right? So you got a lot of industries, or a lot of countries rather, across the world, a lot of different end markets, international end markets that have been performing really well. And even your emerging markets trade, EEM, has also been performing very well. So many segments of the world, at least since the start of the year and even to end last year, right, have been outperforming the S&P 500. So a lot of people ask me, is it good to invest in international markets? Well, it depends, right, at which point in the cycle that you're in. But right now is definitely a very interesting time to have that international market exposure, because we know a lot of these, they just stayed flat for a decade or so, but now finally breaking out. You can see it on EWZ as well, right? EWZ, right, stayed flat for a very long time, starting to slight breakout right now. EWY, Korea, right, stayed flat for a very long time, a decade plus, 2 decades at this point in time, right, for various different reasons, which we'll talk about in a different video, of course. But now international is doing very well. Now, some people will say, well, that's because the dollar is going to zero and you have a flight out of the U.S. economy because people are just not happy with Trump's policies and whatnot. Okay, you can make that argument, but if you really look under the hood, right? There's a lot of way different things going on right there, right? You got in Europe, you got this whole big defense spending and push for catching up basically in AI as well. So they've kind of unleashed spending that they haven't been doing the last 10 years. Brazil is completely different as well. There's a big infrastructure boom right there as well. A lot of large cap companies are doing very well. EWY is just basically Samsung and SK Hynix because of the massive amounts of memory demand in the market right now. And to be quite frank with you, Japan is finally in an expansion territory after doing nothing for the past 2-3 decades, right? They're finally seeing a little bit of inflation. The Bank of Japan is finally having to start to increase a little bit of interest rates, right? Because industrial capabilities of Japan and whatnot, they're going into a form of a, industrial slight boom right now, which is very, very good, right? Certain aspects of the Japanese economy, obviously, guys, I can make a video for like 2 hours on the Japanese economy and what's happening right now, right? But suffice to say, there's a lot of investment into Japan, but also that Japan has been making abroad, and a lot of Japanese companies and services are being heavily utilized for this technical revolution that the entire planet is currently embarking upon, right? So there's many things that go behind this. It's not that investors are just leaving U.S. markets altogether and just flocking into the rest of the world just to do it, right? No, it's that a lot of the rest of the world has just been not doing much in terms of investments, right, into either technology or whatnot, or a lot of end markets have been flat. There's many, many, many different things. As I said, I could talk to you guys about 1 hour about Korea, about, the Chaebol control over the markets over there, et cetera, et cetera, et cetera. Japan, right, their struggles with inflation and economic growth and consumer purchasing power and, just the work-life balance and everything over there. Like, there's just so much to talk about, right? We'd have to do it all in a separate video, but I'm just highlighting the fact that, you can't just listen to a very easy talking point that people have been reiterating, saying we'll just sell everything in the US and just pivot to international markets. You know, that's where the money's going because the US dollar is dead, the US economy is dead, like it's all going to crumble. No. Okay, there's a lot more things going on here behind the scenes. That is the sensationalist argument. The political argument are obviously right. Fact of the matter is that these other countries are doing very, very interesting things now, okay, to basically just kind of join the economic boom that a lot of people are trying to go for right now, chasing AI and chasing efficiency and things of that nature, right? And in a new form of, you know, second industrial push, essentially, for a lot of these countries, respectively. So moving on further here, if we move on to some of the last slides before we take on here, the AI boom is fueling the South Korean economy, of course. South Korea exports surged 47% year over year in the first 20 days of February, the strongest reading in the last 2 years. Once again, this follows a 34% gain in January, second consecutive monthly acceleration in growth. Well, here you have it, right? Korean exports. I mean, it's right there, okay? So it's not flight from the US dollar, like certain people will argue that. There's flight from the dollar into gold because the US dollar is crumbling, the Peter Schiff thesis, right? All things of that nature, but it's far more complex than that. If you want to believe that, then that's your prerogative. I'm just here to say that there's many more things going on behind the scenes, actual statistical themes here in terms of economic booms, right? That are heavily contributing to these end markets being more desirable than they have been, at least in the past 5-10 years. So moving on a little bit further, a couple more for you guys. This is just insane. This guy says, it feels like we're in a correction, but 60% of S&P 500 stocks are beating the index. This is one of the biggest rotations we've seen lately. We've talked about this many times over the past month and a half, so we're not going to spend too long on this. But if you think that market breadth right now is not good, you are clearly mistaken, right? Market breadth has been incredibly good to start off the year in 2026, right? Maybe not in people's favorite companies, the big winners of last year. However, market breadth has been very, very strong to start off the calendar year. 60% of S&P 500 stocks are currently beating the index. Now, I hear the pushback already. Yeah, but that's just because the index has been doing nothing. It's just been flat down, minus 2%, right? Yeah, but still, this is clean outperformance, right? You can't always say, you can't always talk in exceptions, right? You haven't seen this since the early 2000s, this style of market breadth, right? A lot of various industries are participating, and with good reasons. They should, right? And moving on lastly here, the NASDAQ has gone nowhere for 4 months. The Bollinger Band is the lowest since 2016. Similar compressed markets saw the NASDAQ rally 5 out of 5 times over the next 2 to 4 weeks. So take from this what you will, but usually when markets get super, super tight like this, well, obviously the move is going to be big in either direction, which is why a few titles of my video in the most recent few weeks have been, there's a big move coming in the markets. Now, certain of you that are bearish, that are saying that this is just a big distribution cycle in the markets and that this has all been started in October, et cetera, et cetera, et cetera. Okay, no problem at all. Maybe you get the big move to the downside, right? If you're very bearish on the economy, if you don't believe in the jobs market, if you don't believe if you believe that tariffs are going to lead to more inflation, the Fed is somehow going to have to raise interest rates, even though, or rather than cut them, or just the bearish narratives in the market right now. Will you believe that this tightness is going to lead to massive distribution, that you're possibly going for a good 10-20% correction in the S&P, maybe a bit of midterm seasonality? You can sprinkle that into the bear thesis, right? However, the statistic does show that historically, right, you have a better statistical chance of breaking higher after things like that have happened, especially when you couple it with a very strong market breadth. And let's be honest, there's a large swath of the market right now that are very large weights in the index. If you were looking for another 20% correction in the SPY, well, let's be honest, right? You're not going to do it if just the bottom half of the market starts falling off and starts retracing and big tech stays flat. No, a lot of these big tech names will have to pull back another 20%. Is it possible? Maybe. Is it plausible? Perhaps not. They've already dropped so much. But then you might argue as well, Google and Apple and NVIDIA haven't dropped, so maybe the drops are going to come from there, and Tesla as well. It's possible, but just to reiterate, right? So much tech, so many financials already down considerably off their highs. If you are expecting the markets to drop another 20%, it would put us below Liberation Day on all of these names. I'm not saying it's impossible. I'm just saying that you have statistics to show a different story in either direction. I'm still bullish on the markets overall. I think this rotation has spooked a lot of people, has given people maybe faulty cause and effect relationships, meaning, right, the rotation into staples and some of the defensive aspects of the market, you may conclude that that is because the market is in a final market phase, final market cycle, and that you're about to embark on a big distribution phase and crash the markets into another correction. I'm just here to say that there's more to the story, right? That the cause of the rotation may not be that there's fear in the markets right now surrounding the overall status of the economy, and it may not be a massive distribution cycle. It may indeed still be an accumulation phase of very potent market rotation that you have not seen in 4 years, because a lot of those companies that are getting the rotation, they didn't have pricing power in the past 4 years, and they also didn't have these bullish tailwinds in the past 2 to 3 years. The recession odds in the past few years were a lot higher. You didn't have rates coming down. You didn't have very much certainty that inflation was coming down as well. You didn't have $4 trillion in fiscal stimulus. You didn't have the end of quantitative tightening, right? So you got a lot of very bullish macro tailwinds here that have kind of started the rotation before, right? From October, November, etc., and then accelerated into the beginning of the year. So we recapped everything for you guys, everything that's been happening over the past 2 to 3 days. I haven't seen you guys for a while. That's why we spent so much time on it. But just to recap, we said on Thursday as well, right? I gave you guys all the current bearish narratives at play and all the bullish tailwinds at play as well. So if you want more, I mean, not much. I mean, there's a lot that's changed in terms of headlines the last few days, but our analysis that we did last Thursday for about 20-30 minutes to start off the video has not changed. We're still in the exact same market environment where it's very easy to construct a very bearish thesis on the markets. Say the SPY and the QQQs are going to drop a tremendous amount. But on the other side of the coin, right, it's also very easy to maintain a very long bullish thesis. I'm not here to push you guys in a certain direction. I'm just here to present the news, the statistics, what's going on in terms of rotation, and I'll provide my opinion. You are free to disagree with it or agree with it. That is completely up to you, right? I'm just here to present the information to help you guys make the best educated decisions that you can. If you're trying to go short the markets, well, I'm here to present the information. What are your narratives that you're looking for more fuel to short? Or if you're looking for certain sectors, you guys know which ones to do, right? It's very simple. Just wait for the Claude releases and maybe just put notifications on as well, and you'll be able to short just as the rest of the HFT firms and other firms are doing too. But that trade is getting a little bit overdone right now, right? If you're looking to go long right now, well, it's very simple at the same time. Well, you got a whole bunch of opportunities, both on the bottom half of the market, which we talked about a lot to start off the year, but also you can also be rebuilding positions, some, not all, some of the very high quality companies that have sold off from their highs, arguably for questionable reasons, right? Valid reasons sentiment-wise, but fundamentally wise, questionable, right? So that being said, that's the end of your introduction. Hopefully you guys enjoyed that. And now let's move into some actual charts, shall we? So we'll be going over the S&P, the QQQs, and all the indexes, then our big tech names, then our good old biggest gainers and losers of the day. All right, so for the S&P, guys, a very big chop zone, obviously, but the bulls are playing very good defense. Now, talk about the rotation a lot, right? Obviously, so the line in the sand remains still this lower 676 area. We are protecting this support area very well right now. 686 down to about 679. It's a very ugly chart right now. It's just been sideways consolidation, push and pull across many different themes in the market. There's something for everybody in this market, which we've been talking about since the start of the year on the channel. Obviously, if you are a value and dividend investor, you've been doing very well this year. If you were wanting to chase some of the key themes in the market this year, which we described earlier on in the year, such as energy, such as defense, such as the second phase of AI, anything from, connectivity, anything inside the data center to everything that powers the data center, you've been probably doing very well. If you've just been sitting in large cap growth, well, maybe you haven't been doing so well because those are the things that have been getting hit the most recently. That being said, the S&P is holding up quite well in spite of all the volatility recently, and currently no major breakdowns just yet. And I assume if you're short this market, it's very frustrating, right? The VIX is very high right now, but the market refuses to break down because there's just too many names that are participating to the upside, even though big tech and large cap has been getting destroyed, right? It's just too many components in the market holding you up right now. Moving on to the Qs, a bit of the same analysis, although the Qs, the line in the sand, is a bit lower right now, 593. We know that there was a big daily downtrend underway, and the bulls kind of stopped it in its tracks. Now, they've been building a bit of a base of support. We will see if they're able to reclaim resistance, which is 613 up to 605. Yes, we are below our daily moving averages, and yes, on the weekly, you have noticed we've taken a bit more of a leg down, but let's be honest, we haven't really done anything, right? Not done anything at all over the course of the past 4 months of trading, and as a result, you remain in sideways consolidation. Yes, you have the RSI currently pulling back from overbought conditions. The MACD is currently slightly curling over, but there are no major red flags in the market right now in terms of price action, right? It's just very choppy price action, a push and pull between narratives. And you know, it's a midterm year as well, so the seasonality for February is not very good traditionally. So we will see. We'll have to let the Bulls and the Bears continue to battle it out amongst all these various different narratives, but there are trading opportunities all across the board for several people right now. Moving on to financials. Financials arguably getting hit very hard yesterday. That was down 3.35%. A lot of credit cards were down. The banks also had a very negative day because of the AI doom loop that Citrini research kind of highlighted in the markets yesterday too. That being said, clear daily downtrend on financials right now. Very interesting opportunity for financials. They do have a lot of nice tailwinds. The rate cuts, the fiscal stimulus, right? A lot of deregulation as well. So yes, although you do find yourself in a weekly downtrend and a daily downtrend as well, into support, which is 52, then about $50, the monthly in classic monthly consolidation form into the whole previous resistance area, which is current support, and that is the 2025 highs, right? The next stop, if ever we flush down here again, will be a revisit of the 26 EMA. And normally in the context of bull markets, whenever financials come down into the 26 EMA, it's a very interesting position. I did start some leap contracts on financials today. You have other very large people that are taking very big positions in the financials niche over the course of the financial sector overall. And the thing that's interesting about financials is that you have a lot of paths to win here, right? Not only are the credit card companies phenomenal buys, in my opinion, after they've consolidated in a substantial fashion, the banks have also completed their own phase of consolidation, right? Some people would say, well, we're losing financials right now. You're not really losing much, right? They're going into monthly consolidation phases on the banks in context of overall uptrends. JP Morgan, same concept as well, right? Just hugging down into support ranges overall. The banks were in need of consolidation. They got consolidation. Credit cards have been consolidating, and insurance as well has not done anything for a better part of the last 2 years. And additionally, too, you got a lot of the credit rating agencies, SPGI, Moody's, which some would say are being disrupted, but let's be honest, they're not being disrupted at all. We covered these after earnings and explained what was happening, why they were facing such heavy declines. There's so many interesting aspects to financials that lead us to believe that there's a lot of potential upside after these consolidations, right? Because a lot of these consolidations are not based on merit of degrading fundamentals. They're only sentiment and narrative driven. And the person that you should respect the most that has a very large position in XLF right now is the GOAT, Stanley Druckenmiller himself, has a very large position in XLF, trying once again, to benefit from all these declines across the board. So we can now play financials as a whole. It's not only the credit cards that are down and everything else in financials is doing well. No, everything in financials has had significant pullbacks, or like insurance has done nothing for a very long time, which we can indicate that it could be a very interesting time to build some positions here in the broader ETF. Moving on to healthcare right now. Healthcare doing absolutely nothing. They're still stuck in a range. Overhead resistance, 160 down about 158, and below support, 153 down about 151. Now, Eli Lilly has the exact same pattern. Eli Lilly is looking very good. This is a bull flag, right? A very nice bull flag at that, looking very strong on Eli Lilly right now. But healthcare, we know that there's been very weak sectors. So no, I'm not interested in playing the UNHs of the world. I'm not interested in playing NVO. I'll play strength if I'm playing healthcare at all, right? And you guys know the only plays that I have in healthcare in my long-term portfolio are TMDX, and I have ISRG. ISRG will be a very big AI winner. They're already a very big winner in the marketplace, but I like medical devices. Medical devices are probably my favorite play, but if I had something else, if I was going for pharmaceuticals, I probably would build some swing trade longs in Eli Lilly. XLV not looking too bad at all. They're holding, but you need participation, guys. If you want to see the S&P move, in a big way higher, well, you need your three biggest sectors to participate. The Qs, XLF, and XLV, they're your biggest weights in the index. If you don't get at least 2 out of 3 of those moving to the upside and breaking the ranges, either the QQQ breaking the range to the upside, XLV breaking the range to the upside, or at least a financials big recovery, the S&P is just not going to move, right? The bottom half of the market is just not large enough to move the S&P 500, so please keep that in mind. But interesting opportunities across the Qs, across financials, and even in healthcare as well, if you know where to look. Moving on to semiconductors. Semiconductors, very, very strong. They are your market lead bull right now. No signs of slowing down as of just yet. Beautiful daily uptrend. Line in the sand, higher low is down here, 398.76, and the weekly just remains poised in a very nice uptrend right now, looking for higher highs. So no weakness at all on semiconductors. There's many ways to play semiconductors, everything from the GPUs themselves, whether you're willing to play AMD. We'll talk about the meta deal when we cover that later. Whether you play, I typed in GPU, GG's. NVIDIA, also consolidation range, interesting right there. Broadcom, consolidation range, very interesting right there. Marvell, very interesting. Some of you will want to play some of the names like SanDisk, some of the names like Micron for just momentum continuation, and that's perfectly fine if you want to do that. And also some of the equipment manufacturers for momentum follow-through, such as LRCX, such as ASML, pure momentum trades at this point in time, because the equipment manufacturers, for the most part, they've hit top end of the valuation, right? The memory names are still quote unquote cheap. Now, this all depends on whether your view is that these companies are still cyclical or not. I'll leave that determination up to you. I lean to the aspect of no, well, at least this cycle will probably extend well beyond 2028. So there's still some time on these names, but ASML is getting a little bit stretched. LRCX is getting a little bit stretched. So I have holdings in ASML. I'm not adding any more, but playing Micron, playing SanDisk up here with some call debit spreads or things like that could be a decent proposition. Playing EWI, decent proposition as well for your SK Hynix, for your Samsung exposure too. Many, many, many different ways to play semiconductors overall, right? So please keep that in mind. And we'll talk about the photonics trade at the end of the video as well. Fiber optics, glass, etc., like Corning or Coherent or, Lumentum holdings like Light, you know what I mean? Different segments of the market like that, AAOI. We'll talk about that at the end of the video, but many, many, many different ways to play semiconductor infrastructure right now, right? The chips and then everything that goes into the chips as well. Moving into the Russell right now. The Russell holding up very well, right? So if there was truly a very big scare in the market, you would expect the Russell to be down tremendously right now. If it was a question of macroeconomic uncertainty or heading into a recession, the Russell would probably not be all the way up here, would it? That being said, getting really tight up here, right? Clear support down here, 258. The bulls are playing good defense down there. On the weekly time frame, it just does look like a current bull flag of accumulation, possibly for some further longs. The bias is still long because the weekly uptrend is maintained and the monthly uptrend is very nice as well. So the Russell, whether you're in the Russell individually as an ETF or you are in individual companies, there's a lot of alpha in individual small cap companies right now, but they have to be thematic. That is what we focused on since the start of the year, right? Smaller cap companies in energy or anything chips, wafers, and other things of that nature, right? Things like, military trades as well. Thematic trades in small caps have been doing very, very well recently, and we'll highlight a few of those at the end of the video as well. So that being said, that's everything for your overall market rundown. I guess since I haven't seen you guys for a while, this video is already going to be super long. So I guess while we're here, we may as well do it, right? XLP Consumer Staples remains very, very strong too. So congratulations to all the staple bulls out there, whether you are an XLP investor directly or in certain companies. If you're a dividend investor invested in SCHD, the Charles Schwab dividend ETF, that's very popular. Congratulations. This trade is looking very healthy right now. A little bit difficult to chase if we're being completely honest. Now, there are some names that are still a little bit left behind, right? Like Kimberly-Clark is looking pretty decent right now. UPS is still relatively low too, right? So there are some names out there that pay decent dividends that we can still get exposure to if you really want to overall. But XLP, suffice to say, they're already well underway to the move. If you get a bit of a rotation down, you'd be looking for maybe a backtest down here of the mid-80s, which would be a tremendous opportunity to reload this trade, as this trade will probably still be popular as the macro cycle for XLP is now looking a lot better, right? Not in terms of the fear bid for the markets, no. In terms of just the macro expansion of a lot of these companies that did not have pricing power in the past few years. Now that inflation is coming down, now that your interest rates are coming down as well, people are kind of re-pivoting into these for the dividend purposes, because now a lot of dividends from these companies are better than the risk-free yields that you're getting on bonds, at least short-term bonds or savings accounts. So there's a bit of that, but a bit of macro rotation as well. Consumer discretionary right now, XRT, consumer retail, not too bad, right? But just kind of doing nothing over the past few weeks. Overall, in the monthly is the clearest chart in my opinion. Currently underway for a monthly breakout right now. So there's many consumer retail names that have been doing quite well recently. One of them that I have is Elf Beauty. Elf Beauty's been mounting a very decent recovery off the lows, but shout out to many other companies that have been popping off the lows recently, right? Like Chipotle had a nice run off the lows, et cetera, et cetera. So we're not going to go through everyone in this video. We just don't have the time, but some of the consumer retail names that I want to bid are going to be in travel. So Airbnb, big fan right now. Booking.com, big fan. Uber, very big fan as well. Several of those have gotten sold down through the form of various narratives, and I am a buyer of some of those consumer retail facing names, and obviously Amazon, and I got another one there, consumer retail facing as well, which is Mercado Libre, and another one too, which I'm currently bidding Affirm all the way down here. So I'm not necessarily playing, some of these, like, Affirm is finance, obviously, right? So I'm kind of just lumping it up into the consumer spending trade overall. I'm not going to talk about Abercrombie and Fitch or Nike or things like that, right? Not that there's not maybe some opportunities there, but I'm just telling you guys which ones I'm focusing on as part of the whole consumer discretionary overall landscape. Moving on a bit further here, utilities. Very strong, guys. Continues to be very strong. And we highlighted this. Hopefully you guys got a piece of the action down here. Beautiful, beautiful, beautiful monthly uptrend follow through continuation right now on utilities. You guys know my favorite names in utilities. We've brought them up literally almost every video for the past few months. Next Era Energy. This was such a clean pattern, cup and handle breakout. 4 years, guys. 4 years. And look at the quarterly. That is a quarterly MACD cross. That hasn't happened in a very, very long time. So pay attention to it, guys. Secular trend right now. Next Era Energy underway. Vistra also completing its retracement to the downside. Vistra looking very, very interesting in the future. So whether you want to play those, whether you want to play some of the midstream pipelines that we've highlighted too for the data center purposes, of course, such as Enbridge. You guys know that I position in Enbridge to start off the year. That trade's been moving on very nicely too. Energy Transfer Corporation was another one we highlighted at the beginning of the year. These are nice dividend paying stocks in the oil and gas landscape with a bit of a data center twist to them, which is why I'm positioned in them personally myself. There's many ways to play energy, whether you guys want to play Constellation in terms of nuclear or just play the overall nuclear trade with an ETF such as URA. That's perfectly fine, but energy, focus on energy. Utilities, yes, but obviously the energy trade as a whole, whether it's solar plus battery storage or uranium and nuclear, providers or things like that, or just legacy utility providers such as we highlighted like Duke Energy or Vistra or Next Era Energy. There's many, many, many different ways to make money in the energy space right now, guys. Hopefully you're able to at least find one. And lastly, real estate. Real estate hasn't been moving too poorly recently, right? Nice little breakout on real estate. We highlighted a few of these. This is obviously one of the ETFs that encompasses a lot of REITs. And I highlighted my favorite REIT recently, which was Vici. Off the lows, start off the year, right? 28, stocks now at 30. So true, not a ridiculous rally, right? But it does pay a very decent dividend. And REITs are not known to move in the fastest fashion, right? We highlighted O, Realty Income, if you like that one. We highlighted Triple Net. We highlighted Public Storage as well, which could be very interesting around the lows. And now they're all doing really well. We also highlighted the home builders trade a few times over the past few months. There's been something for everybody in real estate since the beginning of the year. Whether you're a REIT investor, whether you wanted to take the home builders thematic trade when we highlighted it in December into the start of the new year, there's been something for everybody. And lastly, oil and gas, good old XLE. Well, XLE is kind of not peaking out here, but it's kind of slowing down, right? So we will see, now that it's overbought conditions on the weekly, we will see if we get a nice back test. If you get a nice back test down here, it'll be a phenomenal opportunity to reload some swing trade longs that I think after 4 years of consolidating, guys, they're on to the leg of expansion, and we will be looking for a monthly higher low into further possible expansion too. Many different ways to play that. I highlighted the midstream pipelines. Exxon is gone, so that one's a bit too gone, but Chevron could be closer to a breakout retest function type of trade right down down there. And obviously we talked about many other ones in the market too. So keep that in mind, right? So that's everything for your overall rundown. Hopefully you guys enjoyed that. Moving on to the VIX right now. The VIX, frustrating if you're short right now, the markets, right? You got the volatility, but you don't got the index breakdown. That doesn't happen very often. Usually in times of high volatility, when people are buying so much protection, we highlighted the put to call ratios on Thursday, the amount of variance, the amount of dispersion between the winners and the losers this year. And a lot of people are waiting for these indexes to break down because of the high volatility and uncertainty, right? And the quote unquote rotation that's been happening since October, November, December. But it hasn't been doing it, right? So volatility recently has been very good. It's a day trader's dream if you enjoy volatility. And also if you're an option seller, you probably enjoy this volatility a lot. Great time to be farming some covered calls, especially on names that have ran a lot that you're looking to take profit on, or selling some put options under the market. It's giving you great distance and fantastic premiums to lock in some very juicy strikes on some companies that have pulled back in a significant fashion. That's how we should be using the VIX, not as a predictive function but rather to understand whether it's a good time to buy options or to be selling options overall. So please keep that in mind, right? Moving on to gold and silver right now. We're going to tackle the metals. So gold and silver looking very, very good right now, guys. We highlighted this as a possible breakout opportunity for some gold longs when we were speaking about it last week, going for the higher low attempts with a lot of demand zones being set by the bulls in the process. Every time the bears try to push down, the bulls said no. And now you do have a very nice leg of expansion. And consequently, over the course of yesterday's action, you got a very nice back test as well, right? A little bit of a back test here by your bulls over the course of the Tuesday session. So very interesting trade. The bulls are back in control here of the daily uptrends. Your daily MACD is crossing as well to the upside. So we might be looking for more longs after the Chinese New Year pause is now concluded, right? And you're just looking for expansion of the weekly uptrend, continual expansion of the monthly uptrend. Your upside targets now do remain the previous all-time highs, 5,600, and then psychological 6,000. So personally myself, I do have a swing trade long on gold. Hopefully you guys are able to make sense of the price action that we highlighted last week as well to build your own swing trade positions too. And we were also saying that silver could be interesting as just a carry trade forward from the gold trade, because gold had the structure. They got the daily uptrend back first. Silver was lagging. They did not get the daily uptrend back. They've just now completed it, but I haven't seen you guys since last Thursday, right? When we made this video here. So we were saying it's interesting, but put a stop loss there. Then you're going for expansion TP1 and TP2 back to the all-time highs. We're now almost at take profit number 1 if you were able to lock in those swing trade lows in the mid 70s. So very strong push right now by silver, regaining the time frames one time frame at a time, completing the big weekly pullback into the 12 EMA. So this trade is underway nicely. Stops can be placed at break even, or a few profits can be clipped out in the process too, as we kind of move on to target, or if you wanted to set a trailing stop, no problem in doing so as well. So congratulations to everybody that's able to get into that trade. I am personally in some gold calls myself. Moving on to Bitcoin right now. So Bitcoin doing a whole lot of nothing, right? Still, bears full control. Now, although we did have a nice little pump today, it's nothing, right? So that being said, guys, daily downtrend is underway. You also have a, weekly big downtrend right now. Monthly, they just unwound the entire monthly move, and your crypto winter somehow is still in motion, right? Ethereum is the exact same thing. There's nothing to report on this chart. Consecutive daily downtrend. What you need to see on both Bitcoin and Ethereum, show me that the bulls want to play. Give me the daily uptrend. As long as we keep just riding this 12 EMA to the downside with daily downtrends, there's no action here, at least not for swing trades, unless you just want to speculate and call this the absolute bottom and maybe set a stop loss below this liquidation flush level right there on the 5th of February. Now, that's possible. It's a very risky trade because you're trading without confirmation. As I showed you, we need to wait for on gold to set the uptrends again, then we could play. Because you know the bulls are back in short-term control. You don't have that right here. The last time you had it was here, where we were able to set tradable stop losses below the lows, because if that's not the lows, right, and that's just a weekly lower high and a bear flag, you don't want to get unwound one level lower. So once again, if you're taking longs here and trading without a stop loss, you don't want to get unwound one level lower if it dips into the 50s or possibly below. I'm not saying it's going to do it. I'm just commenting on the price action, right? In terms of risk to reward. The only thing you can do on Bitcoin and Ethereum right now is accumulate for the long term. That's all you can do because the short-term trade timeframes right now are not conducive to swing trades unless you're trading with stop-loss defined levels and you're looking to call this liquidation bluff on crypto, right? But crypto remains wildly out of favor. In my opinion, there are many other better things to play in the market than crypto right now. We can revisit crypto when it actually starts uptrending again and we can actually find some momentum and find some better tradable levels. As of right now, only people that should be buying crypto are people that are either DCAing for a long-term thesis that are going to be in it for the next few years for the expansion of the next leg of crypto overall. So that's everything for your overall market rundown, guys. Hopefully you enjoyed. Now we're going to spend about 10 minutes doing big tech, and then we're going to spend another 10 minutes after that doing the biggest gainers and losers of the day. So let's move into it, shall we? Okay, so stock number one is going to be Apple as per usual. Apple performing really well recently, well, for a few different reasons, right? Number one, they never spent trillions of dollars on CapEx for AI or data centers. But number two, obviously, is the success of the iPhone product release back in October. And they had very good Q4 earnings. Another little interesting fact about Apple is if you've been following the Claude saga for the AI agents, is a lot of people are running AI agents on Mac Minis. So the demand of Mac Minis has been absolutely through the roof and they're virtually sold out or on back order in many locations. So Apple is an interesting trade, right? Now, Apple is not a long-term ad for me right now because the valuation doesn't really support that because the forward price to earnings ratio is in the low 30s and we're currently at a 3 peg with the revenue growth profile not super strong, right? The chart looks very good for some follow through in terms of monthly uptrend continuation. You would only take this trade on Apple as kind of a counter capex trade. It is one of your winners in big tech right now because it just doesn't fit the mold of everything that's been sold off in the AI fear narrative recently. So there is a theme here to be playing Apple longs for some swing trades just because it's outside of that whole theme. But that is the only type of trade that I currently see on Apple right now. Obviously, this trade should be traded with stop losses as well. The bulls are trying to reset the timeframes, trying to go back for the weekly uptrends right now. And as a result, your stop loss would be 255, and you'd be looking for expansion pretty much towards the all-time highs or higher towards the $300 range as we progress throughout this year. That is the only trade style and thesis that makes sense for Apple because you can't buy it because you think it's undervalued. You would only be buying it because the chart looks very good right now for some upside follow through and because it's counter narrative to everything else that's been happening. Hopefully that makes sense. Moving on to AMD right now. AMD had a very big deal with Meta. Now, this is a $100 billion deal, 6 gigawatts, which Meta will be procuring from AMD. And in exchange, AMD will have to, well, not will have to, but the exchange was that AMD was giving 10% of the company to Meta through various forms of warrants in terms of how sustained performance obligations. I don't know why my lights keep going off right now. Give me a second here. Oh, there they go. All right. So, in terms of, those warrants, right? Meta will be able to exercise those warrants as they buy into these AMD chips that will be provided to them over the next 5 years or so. So a very interesting deal between those two companies, AMD responding well to them, Meta just being flat on the day, but AMD is now back into this whole area, 215 up to 230, which is resistance. And AMD is such an easy trade in my opinion, right? I mean, everything data centers has been working, guys, right? The chips, and anything connected to the chips, semiconductor infrastructure has still been a very popular trade. Now, AMD has been brought down recently as part of just normal consolidation, but as we've been saying, especially after their earnings, around 210, guys, the stock is cheap. There's no other way around it. The stock is cheap. It's trading under a 1 peg right now. And in terms of forward price to sales, it's a 7.28. The thesis for AMD is still very much intact. This new deal is just a very interesting piece to the story, right? But EPS ramp, second half of 2026, and the revenue ramp, second half of 2026 for the next few years. So this trade, we are indeed still early and we are still getting a good price. You're not as early as someone like me who built shares in the 111 range and had some swing calls and now a second batch of swing calls from 165, but you are still objectively early in the grand scheme of the overall thesis. So please keep that in mind. AMD for me is still indeed a buy. Moving on to Amazon right now. Amazon at about 1.6% to the upside today. Decent day for Amazon, but we know the damage has been done. A lot of these big tech names need to get their daily uptrends back, and the bulls are trying, right? So we need to get these daily uptrend back. That would be a break above last Friday's high, excuse me. So trying to set the higher lows and go for the daily uptrend sweep. That being said, we are into resistance right now. 216 down about 205 is your resistance range. On the weekly chart, it's pretty much the same, right? We know that we lost a lot of the time frames. Give me a second, I'll just refresh. So the weekly timeframes were lost in the process of the past sell-off because of earnings as well, but formed a very nice base, right? We never really closed much below the 200 range. You guys know my piece on Amazon, right? I think Amazon's going to be a big winner. All aspects of the business are firing on full cylinders, whether it's AWS reacceleration of the growth, whether it's their advertising business, whether it's their e-commerce business, the pharmaceutical business, their push into robotics, Project Kuiper with their low orbit satellites. So many different aspects to the Amazon thesis, guys, and I love every single one of them. That being said, yes, they are spending a tremendous amount of money on CapEx, but Amazon has always done that. They are arguably the king of CapEx and have been for the last 25 plus years at this point in time. I do believe their ROI on that CapEx will be fairly substantial as this company moves towards $1 trillion in revenue by 2028. So fantastic buying opportunity for Amazon. I will maintain that around 210. You're trading at a 427 PE and a 1.35. So arguably the company is trading at a fairly decent valuation right now. Moving on to Google. Google down about 0.25%, not able to fully recover. Google as well, caught in a bit of a daily downtrend right now. We will see if they're able to change the trend back around. We are under our daily moving averages. We are closely tied into this area right here of about 297. I mean, it's the closest line in the sand that we have, right? So Google is currently underway into its weekly consolidation phase and consequently monthly consolidation phase as well. We were saying that Google is fairly rich up here, but that I'm not selling any shares. I mean, it's not even crazy rich, right? It's trading roughly around a 28 forward price to earnings, just under 2 peg right now, and any further consolidation would be a nice buying opportunity. I'd be very interested in picking up some swing trades on Google if we somehow make our way back to the 280, 275. If it doesn't get there, no problem at all. I got tons of other swing trade ideas on the table right now, but I'm not selling any shares. I'm just not buying any more up here either, since most of my buys were made at much lower levels, of course. Moving on to Meta. Meta up 0.32% today. Obviously, they were tied into that AMD deal. Line in the sand for Meta right now, 628, right? So once again, big daily downtrend after earnings. You gotta give me the daily uptrends back. Only then can you say, yep, that's the true bottom, and they won't just get back to one lower area, which would be 600 down to 561. That being said, Meta right now, the chart is arguably, guys, it's just not a very good chart, right? It's a very ugly chart. You got the head and shoulders here on the monthly time frames. So this is a scenario in which the chart does not look very good, right? It's kind of all over the place, right? And that being said, the one thing that's positive about Meta is the valuation. So swing trading Meta from here is not super obvious. There is one very obvious line in the sand level. If you guys are going for big swing trades, a break of 601, right? What you're going for here is the weekly uptrend recapture after this massive post-earnings sell-off. 600 would be your stop loss. Take profit number 1 would be 743, and take profit number 2 would be a break of the all-time highs, 800. So there is an opportunity here to go for some meta swings if you're using the higher time frames. All of you that just don't want to do swing trades or can't afford to do swing trades, well, buying the dip here for long-term portfolios is extremely attractive, guys. Extremely attractive. It's trading right now for a low 22 forward PE and almost a 1 peg. You don't really find Meta down here in the low 20s PEs and around a 1 peg, right? So long-term fundamental buys here through low 600s. I'm a big fan in increasing the Meta position. I think they'll be much higher, into 2027, 2028 than they are right now. Moving into Microsoft right now. Microsoft also with their own narrative problems. It was up 1.18% today. They got destroyed off the Citrini article yesterday with the rest of SaaS. It's kind of unfortunate that Microsoft is just being lumped up with the rest of software as if they didn't have one of the most incredible moats in the entire market right now, but such is a sentiment-driven sell-off, right? Now, some people would say, well, they deserve it because of their close ties with OpenAI and missing Azure revenues by 1.5%, right? I think the sell-off is a little bit overdone, but you guys know that by now. But the one thing Microsoft bulls have to do is get the daily uptrends back right now. So that being said, daily oversold conditions and daily bullish divergence as well. But still, you can have all the divergence in the world. You can be oversold on the daily. You can be oversold on the weekly. By the way, Microsoft is the most oversold that they have been since 2006. okay, since 2006. Also, we're into the 200 weekly EMA, something we've only tested during the 2022 bear market, and previously, you'd have to go all the way back to, well, they barely grazed it in 2015. Prior to that, you'd have to go back to 2012. So many historical events on Microsoft happening on a technical basis. Oversold on the weekly, the most that we've been since 2006. Weekly 200 EMA, which is also your 50-month EMA, which never happens. Microsoft is also off the highs by roughly 31%. The valuation on Microsoft right now, just take 5% off of this, low 20s multiple at about a 1.3, 1.25 peg. Very cheap valuation. So technicals at some of the cheapest areas they've been in terms of RSI and whatnot, right? Some of the most short-term oversold conditions Microsoft has seen in a long period of time. Some of the most favorable valuation metrics that you've also seen in a very long time, but they got to get the trend back first that we can say that this is absolutely the true bottom and start putting in some moves here and reclaim the weekly time frame. So far, so good. They are holding the last line in the sand, which is 385, but any break below that, and you're going to do the exact same thing we did during tariffs, right? Because there's not much. There's these small little guys down here at 370, and then you're right back into 350. I would be highly surprised if Microsoft drops in the 350s. Nothing is impossible, but suffice to say, I am building, my Microsoft position is already built, right? But I'm buying more Microsoft shares, and I am a big fan of leap call contracts on Microsoft from down here from the valuation purpose alone and how oversold it is and where it is on the chart. I am a fan of buying December 2027 leap call options. Moving on to Netflix right now. Netflix also in the news today after Warner Brothers increased their Paramount increased their bid for Warner Brothers to $31 a share. Right? So Netflix is currently offering $27.75. And, Paramount had 7 days. Netflix offered Warner Brothers 7 days to review another offer from Paramount. And, obviously Paramount put in an extra bid. They bid higher. They also agreed to pay Netflix's termination fee because if Warner Brothers actually goes with Paramount instead of Netflix now, they'll have to pay a $2.8 billion termination fee. Paramount agreed to pay for that. I don't know why Netflix did this, but there's a part of me that wants to believe. Now, keep in mind, this is just my theory, right? The company hasn't said this. It's my theory out there that because, you've seen such a massive share price destruction from Netflix, and the bid has now been so high that Netflix is weighing a couple different things right now. The deal can be accretive for their business in the long term. Yes, this is true, but will it come too much? Will the impact to the short-term share price be too much? Right? Basically, are they going to piss off investors too much for going through this deal for too much money, acquiring too much debt on the balance sheet that shareholders won't be happy? And then they just give Warner Brothers a 7-day window with Paramount just to make Paramount go over the top with a ridiculous offer that Warner Brothers shareholders will probably take. And that way Netflix gets a nice termination fee and can resume course. It's possible, right? That Netflix just did this to maybe get themselves out of the deal now that the deal has been laboring on for just so long? Possibly, right? Then again, management is also focused on the long term. Warner Brothers would be a very nice asset to Netflix's business overall. So it can go either way, right? I guess we're gonna have to wait on the next earnings call. If ever Paramount actually is able to get Warner Brothers and Netflix doesn't get them, I assume a few analysts will ask them on the next earnings call, hey, did you guys give Paramount an extra 7-day window because the terms of the deal just weren't favorable upon further review for you guys anymore? Or what happened there? Because that's fairly unusual when you have a deal that's locked in like that to offer the opposing party to counterbid higher. We'll see what's at play right there. But Netflix responding a bit well to this news, obviously, right? But same thing for Microsoft, right? Give me the daily uptrend. Every time I've said this for the last 2 months, they haven't been able to do it. No cracks above the 12 EMA, no daily uptrend. So now we have equal lows, nice push off the lows. We will see if they can do two at once. Give me the daily uptrend and the reclaim of the 12 EMA, and you will change a structure of price action that has not changed since the month of November. And then we can talk about, all right, let's measure the size of the bounce on the weekly. Can they get the weekly trend back? And as a result, we will measure whether or not this is the end of the monthly move to the downside, which has brought us into the 50 monthly moving average, the 200 weekly moving average, and super oversold conditions, kind of like Microsoft at the current stage, right? That being said, short-term swing trades, you do have if you're looking for that attempt, right, you have a tradable bottom right now, big oversold conditions, okay, weekly oversold into the weekly 200 EMA, you have a tradable low. If you're looking to trade Netflix, swing trade Netflix for the daily recovery into weekly uptrend. Well, first target remains your resistance ranges, right? Top end at 86 and they're into the 90s. Stop loss there, TP1 and then TP2. Decent risk to reward, but trade with a stop loss because you do not have time frame control. This is counter trend for now. It's making an attempt at calling this the bottom. If you're a long-term Netflix investor, it's been the same since 90. We kept saying it's been a great time to just DCA and build a position on Netflix if it's something that you've always wanted to do and haven't held the company, or if you've had the company and wanted an additional reason to buy. They're giving you very good valuations because the fundamentals definitely are not a question here. It's the narrative and the sentiment, which is a big theme so far in 2026. Moving on to NVIDIA right now. So NVIDIA has earnings tomorrow night. We'll be recapping them on the channel. No sense in discussing the price action. All we can say is talk about the expected move. So let me just go to the expected move, and it should be about 7% if I recall correctly. Let's just pull it up again. So NVIDIA, expected move for February 27th, you're going to be looking at a 5% move, as a matter of fact. That's a bit light. I expect them to maybe move a bit more than that, but if that's what the options market's pricing in, I guess that's what they're pricing in, right? So 5% to the upside from here, or 5% to the downside would put you right back down into support. You guys know the game. NVIDIA is going to have phenomenal earnings. Nobody doubts that, right? How the market react, how the price action and the algos react to it, that is a different story, right? But one thing is for sure, they're going to crush the numbers and they will give ridiculous guidance. And Jensen is going to once again say AI demand is relentless, etc., 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 right? However, if we do drop, we'll cover it on the channel. If we do drop, you guys know I'll be a buyer down here. And if we rally and start breaking out, guys, that's a big breakout, a very big breakout that we've been waiting for months and months and months and months. In my opinion, this earnings, right, if it is the breakout catalyst, I do believe that if it does break out, it's gone. So hopefully that you've been doing a good job of either building some lead positions or accumulating some shares. Every time we've brought this up in the last few months, under the 180 range, 180 to about 170 was the target range of accumulation. We'll see what happens on NVIDIA earnings. I'm very bullish into it. We'll see how the algos react. Moving on to Tesla right now. Tesla not doing too bad, as a matter of fact, but still need to get the uptrends back. You will need to see follow through on this daily uptrend attempt, which will bring you into possibly another weekly rally as well. What they've been defending really well is this whole 405 and about 385 region right there. And as you can see, we've just been in a elongated monthly consolidation phase, right? Very long monthly consolidation phase, reacting perfectly from your 12 EMA over the course of the sell-off in the past month or so. So I'm not taking any swing trade positions on Tesla, but you do have a swing trade low in right now at about 383. Obviously, your target would be a break or close to the all-time highs, 475 up to 500. So there is a swing trade idea here with a stop loss below a clean support level, right? And then you're targeting upside expansion on the higher time frames. So this is not like a 1 week trade, a 2 week trade. No, this is a multi-week, multi-month swing trade attempt for recapture of the higher time frames here and going for expansion, so keep that in mind. Moving on to Palantir right now. Palantir is down 1.35% on the day. Palantir just can't shake off the SaaS narrative either, even though they are one of the best companies in the AI landscape overall. In my opinion, the valuation has always been a concern for Palantir, at least over the course of the past year or so, since it's been up here, right? That being said, phenomenal sell-off right now on Palantir. Palantir is right now down from the top. It is down 39%. Now you may say, yeah, well, it's down 39%, but it's still trading at a 1 million price to earnings. And that might be true, right? But they're trading at 2 peg right now. Price to sales is still extreme, but 2028 price to sales is not so extreme anymore. So the valuation has come down from previous highs. Okay. Now that being said, you guys know my stance on Palantir. You should only be buying Palantir down here, and down here is a decent buying opportunity. It's not best. That would obviously be $50. But short of a massive market disaster, you're probably not going back to $50, right? So that being said, is it a good time to buy Palantir? Yes, but only for certain individuals. For people that are looking to hold this company over the next 3, 5, 7, 10 years and looking for them to expand their business model into the thesis of it being a potential trillion-dollar company on the horizon. So please keep that in mind. Decent time to be nibbling on Palantir shares if you're fine with the valuation, if you understand the business model, and if you're a long-term investor. Swing trades, you can make a decent attempt right there. Tradable low is in right now at 125, but that's a little bit too tight. Probably below something like a 115 if you want to give yourself a bit more of a margin of safety. And then, of course, you'd be targeting a re-expansion of the levels back into possibly the 150 all the way up to about the 170 range for swing trade longs on Palantir. Moving on to SOFI right now. SOFI up 2.41%. They also got sold off as part of the whole fintech trade, SaaS trade, everything under the sun trade, right? So that being said, unfavorable price action from SOFI cracking through a very big level, right? Phase 4 of the good old rollover sell-off into distribution. So that being said, 25 down about 21 was the support range which they cracked overall. Big sweeping weekly downtrend right now, which leads us into the good old monthly consolidation phase that we were talking about all the way up here. And we were saying, yeah, comes down to low 20s. It's a decent time to buy, but save some money for the DCAs down through 17, 16. And look at that. We're obviously down there as well. So big monthly retracement, nothing wrong fundamentally with the company. Under 19 bucks, you're at a 0.96 peg and a 5.27 forward price to sales. Very strong numbers by SOFI, but the price action has been abysmal, right? So what I'm doing is I was assigned some shares at 21. They now have covered calls on them. Those covered calls are working flawlessly, and we will be DCAing down here 17, 16 and building a position on SOFI within this pocket of interest during this monthly consolidation phase. Once again, you also do have a little bit of bullish divergence forming on the chart right now on the daily time frame, so keep that in mind. Daily oversold conditions, not weekly oversold conditions just yet, but big sell-off on SOFI. Interesting play, but I would not be expecting this type of price action, right? No, the recovery, because we don't have the daily or the weeklies, will take some time, but a decent area to be accumulating some further longs. Uber, same concept, right? We don't have the daily uptrends, not yet. Daily higher lows are right here, 68.88. We'll be looking for the recapture of a new daily uptrend. Until that time, bears remain in full control of the daily. They remain in full control of the weekly time frame as well, which means you're in a big phase of monthly consolidation, which we've been highlighting for the last few months on Uber. Phenomenal opportunity right now to be in this stock as a long-term investor. If you believe in the company, believe in the thesis, I'm not trying to convince you. I'm just saying if you are, it's a good time to buy, right? At 75 bucks or low 20s multiple, a one peg as well. And obviously Uber has tremendous network effects with all their earnings performing very well recently in the most recent quarter, which we did cover on the channel. So keep that in mind. Not the best for swing trades right now because the levels are very tight and the bears control a lot of the price action. A lot of people on these swing trades will want to wait for confirmation of new uptrends, right? But a decent time for a long-term investor right now. And TSM is the same thing, right? So TSM is just a pure momentum trade at this current stage. Fantastic company. We say it all the time. Maybe not so much for a buy for long-term investors up here, but what we have been highlighting is the number of times that TSM offers swing trade longs from the 12 EMA. If you're just looking for a consolidation into further runs here on the daily timeframes, the good old breakout retest trades, whether they're on the daily or the weekly timeframes, it's very strong because TSM, you know, they're part of the whole semiconductor infrastructure trade, which has just been extremely strong for many different names. We'll talk about a few more here at the end of the video, right? So TSM is kind of like it's kind of like Apple in that respect, right? I mean, they're not exactly like Apple, but they're in the aspect of they're a very favorable position in the market right now. Limitless demand for TSM, not limitless, but you guys know what I mean. Very strong pricing power, and the stock is just in favor, right? It has the momentum, it has the uptrends across everything, whether it's monthly, weekly, and daily. That being said, you guys know how I play ball on these momentum trades. You do want to wait for a bit of consolidation areas, at least pulling back into some weekly moving averages to give you guys some better entry longs. So at the current stage at 389, if you're buying up here, you're just buying for just turn your brain off, right? Close your eyes and turn your brain off. You're just buying for the pure momentum. It's not truly my style. I like to play at least retracements, as we have been saying, as part of the very nice upswing higher. But TSM right now trading at 10% of this valuation. It's trading just under 30 forward price to earnings, about a 1.5 peg right now, and a 10 price to sales. So you can't really say it's cheap, but you also can't really say it's egregiously expensive. Strong company, very much in favor. I'm not selling a single share of TSM, but I'm also not really buying any up here for the long-term portfolio. Only shorter-term swing trades would be a consideration if I were looking to do that on any pullback. So that's everything for your overall market rundown. Hopefully you guys enjoyed that. Now let's spend about 10 minutes on the biggest gainers and losers. But once again, I'm not just going to go through these losers right here and say, okay, well, FICO and SanDisk, and no, I'll cover a lot of them, right? But we'll go through themes that same themes that we talked about on Thursday, but themes that you should be interested in. We'll cover some long-term buys for the long-term portfolios out there. If you're looking to build positions in high-quality companies, I'll share some of the buys that I've been making. That we'll do first, and then we'll do trading themes that you guys should be paying attention to, all right? So that's how we're going to split this section up. Let's do it. Okay, so long-term portfolio positions. Obviously, you guys know my stance on big tech. We're not going to talk about big tech. We're going to talk about anything outside of big tech that I either hold in my long-term portfolio or have recently acquired in my long-term portfolio. So let's start off, right? Mercado Libre, they had earnings today, phenomenal earnings, great sell-off on the company, currently underway right now in terms of from the highs, very compelling valuation on a forward basis. I like this one a lot. So that is something that I have been building a little bit more recently, right? We're not gonna talk about big tech, we're talking about all the other things outside of big tech. Shopify, we brought this one up a few times since the earnings. Shopify, big fan of building the position here from the lower 100s down through the lower 90 level. If they do give us those opportunities, Shopify, definitely a play that you should be interested in. If you haven't seen their earnings coverage, we did cover them February the 11th, so make sure you go watch that video. AppLovin, also phenomenal company. If I'm looking for one company that's been sold off a lot in the software niche, let's call it, because let's be honest, right? The software sell-off extends far beyond only pure play enterprise resource players like ServiceNow or things like that. I'm not buying ServiceNow, I'm not buying Adobe, I'm not buying Salesforce. AppLovin will be one of the first ones up for consideration because of the margin profile, and because of how cheap this company currently is. Not that other software companies aren't cheap right now, but this one has the growth that I'm looking for if I'm looking to play upside. The same thing can be said about Reddit, right? Reddit has phenomenal growth of revenue and both EPS, and right now in the low 140s all the way down through 120, it could be a decent position up for consideration if you're looking to build something in that respect, right? Another company that I don't bring up that often, but that had ridiculously strong earnings today is Axon, up 16%. We talked about this one in the past few weeks when it was coming down here into its 200 weekly EMA. Now, the company was not the cheapest, right? Now, these earnings are stale, so don't read those, but this valuation is not. At 430, when we did the valuation for you guys last week, we showed that indeed it was a 3-peg, but it is kind of a unicorn company. There's not really a company that has the ecosystem that Axon has right now. Very strong growth rates, very strong management as well. Even at 513, not a bad pickup if it's something that you are interested in. 513 down to lower 400s was the area of the pocket that we were very interested in possibly building positions to, right? So please keep that in mind for some of the long-term portfolio positions that I've been really looking heavily into or adding to my long-term portfolios with the most recent sell-offs overall. Those are just the ones off the top of my head that we can cover over the course of the day today. Now, if we want to talk about themes and everything like that, well, you guys know software. I'm only playing software with IGV calls. That's all I'm doing. I'm not buying ServiceNow. I'm not interested in buying some of these pure play software players, the ones with high employee counts and the ones that rely on customer retention and pricing power because they've just lost all visibility. Now, I'm not saying that there can't be some attempts for some swing trades and some mean reversion trades on ServiceNow, on Adobe, and CRM. I'm not saying these companies are also going out of business. What I am saying, though, is that you may get a recovery, but over the next few quarters, next few years, you will always have to contend with the new Claude releases, the new Gemini releases, et cetera, right? Which is why I'm not a fan of putting these in my long-term portfolio because you have a lack of visibility for the next 5 years. 5 years ago, 7 years ago, you could say that these trades were easy money, which is why a lot of institutional investors were in them. Recurring revenues, decent margins, right? Very good client retention. But now, with the influx of AI agents and the seat risk that a lot of these companies are facing, the next 5 years are a bit more unclear than the last 5 years. You haven't seen any disruption come up in the earnings so far. And we've been very clear on that on the channel. So the reason that I'm playing IGV is for a swing trade. This is just a software ETF. I'm looking for a swing trade mean reversion long, looking to play some upside, but I am not looking to place many of these companies in my long-term portfolio at all. The only ones that have been sold off that I've been placing in my long-term portfolio are obviously Microsoft, right? But SPGI, and Moody's Corporation, and Booking.com, okay, and Airbnb, right? Those are the only ones that I've been placing in my long-term portfolio. okay? Because I believe that there's less overall disruption risk there. Booking.com is the same thing. You could argue that AI agents are going to allow you to have a more streamlined travel experience to where you can just prompt an agent and say, find me the cheapest flight, find me the cheapest hotel. But that's not how people usually travel, right? Not at all. Maybe for the cheapest flight, yes, but it's funny because the integrations of ChatGPT and Gemini with these websites, they don't want to be the person of the chatbots, the LLMs. They do not want to be the agent of sale. They don't want to have to deal with the customer service that would come from that, right? And they've been very clear on that. Gemini doesn't want to do it, and ChatGPT doesn't want to do it either. They'll be a nice information resource tool, but they're not going to be the ones processing the transactions for travel. And additionally, people don't travel that way, right? Think of how you travel. Think of how I travel, right? You will want to see, you will want to compare different hotels. Not only take the AI recommended 3 hotels, right? No, you're going to want to look into them. Where's the location, right? Is it close to the attractions that you want to see? Is it close to public transportation, right? Is it family friendly? Does it have good reviews? What are the pictures? What do the rooms look like, right? That's how most people travel, right? It's not as simple as just plugging something into an agent and say, build me the cheapest trip possible to Mexico. You know what I mean? There's so much more that goes into it. Kind of like what we talked about earlier with Uber Eats and DoorDash about agentic commerce overall, right? So it's just not so simple. So that's why I think Booking.com is a phenomenal pickup for me, Airbnb as well. And I am picking up SPGI and Moody's because I think they have some of the most defensible moats in the game right now. They got sent down because of the analytics portion of their business, but that's irrelevant, right? It's all about the, well, for SPGI, the indices business and the rating agency business, and for Moody's Corporation, all about the ratings businesses as well. And by the way, those analytics platforms are proprietary data, right? The LLMs cannot have them in their database without a license to use that data. LLMs are a search query function, right? They do not have proprietary data of their own, so keep that in mind. That's why I'm adding those. I'm not adding any ServiceNow or Adobe for their professional services, or things like Monday.com or Atlassian or that whole suite of products, right? Or Salesforce, right? I'm not doing that because there's too much seat risk and too much uncertainty in the next 5 years, right? And once again, when I say uncertainty, I don't say these businesses are going to zero. I'm just saying that you'll have some rally recoveries, right? But will these businesses go back to trade at 25 times earnings, 30 times earnings because they have great predictability of earnings with no disruption risk? No, you can't say that, right? I'm not saying AI agents are going to disrupt these companies overnight. That's not the point, right? I'm just saying the next 5 years are not as easy and not as clear as a trade as the last 5 years have been for these companies. So please keep that in mind if you're exploring adding these companies to your long-term portfolios. They're not my favorite picks. I gave you guys my favorite picks and why as well. So hopefully all of that makes sense. Now that we're through most of the the software narrative, theme sell-off, the long-term portfolio plays that I've been adding outside of big tech to my portfolio as well, let's talk about some of the thematic trades that keep coming up time and time again. So theme number 1, we'll take a look here. Theme number 1 is going to be one of the names that were on the lows today because there was a short report put out by Citron Research, not Citrini, no, Citron Research, about the possible NAND prices into the future, right? Or you can read that article on Twitter yourself, right? But memory, guys, the memory bottleneck is very real, right? So these are companies that I would not put necessarily in my long-term portfolio because most of the move has already been made. There's probably a lot of meat left on this trade because the bottleneck will extend largely into 2026, 2027. That being said, SanDisk, Micron, and EWI, very interesting for momentum continuation trades, okay? SanDisk and Micron have consolidated now for a while, giving you a tradable low. Okay, so keep that in mind. And Micron as well, kind of the same concept, right? They've established a bit of a bull flag pattern here, tradable bottom. So if we consolidate for a little bit right there, healthy price action in my opinion, bulls control the higher time frames, and the narrative is there. The valuation is also not that expensive on Micron, SanDisk, or the South Korean players, SK Hynix, and Samsung, which most people will find it easier to trade through EWI, the South Korean ETF. Keep that in mind. So I do have positions right now that I've been building for some swing trade longs on Micron. But shout out to SanDisk, shout out to EWI. EWI will probably get a little bit of money from investment for me. That is a core theme, right? The themes that we'll be discussing here are either bottlenecks in the future. See, this is a bottleneck trade right here, right? It's either bottleneck trades or themes that are that just have tremendous backlogs right now and tremendous amounts of money being thrown at them, right? Another one of that, speaking of which, right, are the construction companies. So fixed comfort systems, names like PWR, Quanta Services, names like Dycom Industries, which is the one that I'm playing personally right now, LGN, which is another small cap name. These are all construction companies, okay, for the data center build out. The backlogs of these companies are absolutely massive. The charts are gorgeous right now in terms of continuation on the breakouts. So if you're interested in playing these and potentially waiting for pullbacks, whether you're using daily pullbacks or whatnot, very strong niche to be in for the remainder of 2026, even into 2027. These names will offer some phenomenal consolidation phases into further breakouts. These are big institutional trades right now. So pay attention to the construction aspect of the data center trade. Another very popular trade right now, of course, that we've talked about is energy. So I'm currently playing Next Era Energy for some upside longs, but shout out to other companies such as Vistra, and I also have a company right here, which is TE Energy for vertically integrated solar across North America. I'm also playing FLNC, but shout out to EOSE. There's nothing wrong with EOSE. Very nice nascent technology right here with a longer battery cycle than traditional lithium ion. So keep that in mind, right? These battery energy storage plays plus solar need to be further explored. You have to keep them on your radar, so please keep that in mind. Energy, whether you're playing it through utilities or direct battery energy storage and and solar, or potentially playing the uranium cycle right here with an ETF like URA or NUKZ, definitely keep those trades in mind. These are all very valid ideas. These are the bottleneck trades. Once again, right? There's not enough power. Construction, there's not enough construction right now. They're just firing on all cylinders. They just can't do it, right? The energy trades, whether it's those or the gas turbines from GE Vernova, when you get some phenomenal pullbacks, like we were highlighting on the channel many times during these pullbacks, right? If you're waiting for these pullbacks, they will be in vogue for the next few quarters, the next few years. So keep that in mind. The energy trade is very big right now, guys. Very big. There's not enough power to go around. The other sector right here, critical minerals, okay? We talked about this one many times, and USAR is finally ready. I do now have a position in USAR. Leap call debit spreads for me personally. We know the government has direct intervention into this company. They've acquired indirectly a stake through various forms of warrants and whatnot. So they have a direct position in this company right now. Whether you want to play USAR, whether you want to play energy fuels under quadruple U's right now, very nice base of support forming right now. Whether you want to play antimony companies right now too, which is very strong, right? UAMY looking very nice, building a base of support, looking for the further expansion. There's so many of them out there. Whether you just want to play a critical minerals ETF, which is just a combination of copper, lithium. There's a bit of silver in here as well. You can play these things under an ETF if you're looking for critical minerals. SCTM is just one of them. MET could be another one. I don't know where it is down there, but there's a few of them, right? These look very strong for continuation breakouts and just persistent themes in the market right now. So critical minerals, it will be a theme. This, once again, is a bottleneck trade because China controls almost all of it. The US has been making big efforts to reshore a lot of its production back, but it takes some time. So obviously this will be a key theme as part of a bottleneck trade for the next few years. And shout out to LPTH, which is another form of a bottleneck trade in terms of germanium for military, guidance, imaging systems and guidance systems and whatnot. So there's many different ways of playing this one. I'm in this one personally. I am in USAR as well, but there's many different ways to play. Nothing wrong with playing an ETF. And speaking of minerals as well, copper bottleneck. Once again, a bottleneck trade. So this should be these are the things that you guys should be looking at, right? What is there not enough of for this big old AI boom? Instead of playing the software companies trying to buy these lows, if we're playing momentum here, if we're playing things that are favorable, we got to play the things that will be favorable for a long time to come. It's not to say that we won't have pullbacks, right? Because nothing moves up in a straight line. A lot of these are extended, but if you're looking to play pullbacks, play consolidation areas on things like copper, there's just not enough copper, right, to go around. We've presented that many times during January as some of our key themes and sectors to pay attention to. And this is the whole part of the minerals trade, right? So keep that in mind as well. Moving on a little bit further here down our list of key themes. The next key theme, of course, is military and drones. There's many ways to play this. You can either play it through an ETF. I'll always give you guys the ETFs, right? You can play this through ITA, Military Defense ETF, Aerospace and defense, because we know a lot of the individual players such as Lockheed Martin are just printing highs, Raytheon just printing highs right now, Northrop Grumman printing highs right now, right? And so many other things in between. General Dynamics, obviously doing very well. General Dynamics is a beautiful chart looking for some expansion right now on the highs. Military, why? Well, because there's just like $1 trillion, $1.5 trillion of military spending by the U.S. Into the next year and a half type of thing, right? So obviously that's going to be a very popular trade. Now, if you don't want to play the individual large cap players, right? There are many smaller cap players that we've highlighted a few times on the channel. You could talk about the drones, such as AVAV. AVAV is in a very nice buying location right now. We can talk about Kratos. Kratos is in a very nice high swing low location for some possible further longs. Very, very interesting types of plays there as well. We can talk about some of the smaller players that I have as well, such as Kraken, which has direct partnerships with a lot of the shipbuilders, and with Anduril, which is a very big player as well. This chart is gorgeous on the weekly time frame too. So there are various forms of and ways to play the military/drone theme that will be very popular for years and years to come. Huntington Ingalls, shipbuilding, very popular theme, very popular name as well right now. And the market caps are not very large, 17 billion. This company is already doing, something like 12, 13, 14 billion in the next year or so. So you can clearly see, right, the market cap is not extended. On a few of the smaller cap names, yes, I know you guys want me to talk about Ondas. Ondas, we brought it up many times. Beautiful swing lows for some possible accumulation, right? Down here, my best targets for Ondas was in the 8 handles down to the 6. If they would have given it to us, they only gave us 8 for a little bit of a nibble. It's not looking bad. But once again, these are like multi-year plays, right? So aerospace, defense, and drones. Obviously, I have limited time on the channel. I could make a video of an hour of all the defense plays on their own, an hour about all the energy plays, but we just don't have the time right now. I'm just here to give you guys a few of the key themes. Obviously, I'm not going to cover all the names, right? Maybe some of you guys want me to talk about CCJ when I bring up uranium, right? I can't necessarily do everything, right? The key themes are the ones that we talked about right now in today's video, so pay attention to them because they've been working very well. And the last key theme that I want you guys to pay attention to for this year, right, is going to be photonics, optoelectronics, or fiber optics, okay? Many players in this theme right now, a large amount of demand, and this will be a theme. This is part of the second order of AI, the phase 2 of the AI trades. The past few years have been GPUs. They had their run, right? Now, we're coming inside the data center for, the coolings. I mean, Vertiv has been popular for years and years and years, right? But if you're looking for the next thing that the institutions have been heavily bidding recently, and I mean recently in terms of the past quarter, GLW, Corning, okay? Pay attention to it. Very big deal with Meta. That one is gone right now. Pay attention to it. Daily pullbacks, trade your swing lows, okay? On these pullbacks to the 12 EMAs. Very strong momentum right now. Coherent. Very strong momentum, beautiful chart every time. Just use these 12 EMAs, right? Since September, the past quarter or two for these companies, very, very strong, right? Extremely strong. This is once again semiconductor infrastructure, right? Connectivity, wafers, cables, and now fiber optics and things of that nature, right? So pay attention to these names. The leader of the segment, of course, is Lumentum Holdings, light, but it is gone right now. So there are other ways to play this, but these two, upon weekly consolidation phases, decent to play some momentum, right? Decent to have some exposure through call debit spreads, swing shares, or things of that nature. Pay attention. I'm just giving you guys the themes that you should be looking into, because a lot of these names, guys, I mean, it's not me, right? You just got to look at what has been working really well, and a lot of these are newer themes in the market, right? If you take a look at some of the names here on some of the highs, you will notice that many of these names are within some of the names that have been performing really well to start off the year, right? Sienna Corporation, another one, okay? Just look at these charts, right? I'm not saying full YOLO here after, a 3-4x rally or something like that. I'm just saying if you're looking to play trending markets where the big money is right now, these are the trending markets where the big money is, okay? If you're trying to swing trade big tech, or you're trying to swing trade software, you're trying to play the unfavorable trends right now, it's not going to work. Those are good to build longer term positions, to play mean reversions with long duration leaps and long duration shares, and I'm doing that too. But if I'm looking to swing trade the markets, then I have to be doing it in these sectors where the trend is indeed your friend, playing the pullbacks casually, right? So keep that in mind, right? We got fiber optics right here. You have military and drones. You have energy. You have memory. Few of the themes that we've highlighted in this video. And number 5 was construction. The construction builders, right? The PWRs of the world, right? The fixed comfort systems, the DICOM industries, right? There's more, but you guys need to be aware of these themes, okay? So whichever company in those themes you want to play, I'll give you guys 70-80% of the work, right? But thereafter, I'll give you some hints as to what I'm playing, right? But you also have to put in a little bit of work on your side to determine if any of these are suitable to your risk profile. Do you enjoy trading these? Do you enjoy following these themes, right? Or would you rather just buy high quality compounders, which I gave a lot of them that are on tremendous discounts right now in the overall markets. Long-term quality compounders for long-term portfolios. You buy them at lows, you just set them, forget them, you let the business model do the rest. Right? Spent a lot of time on that in today's video, but we also spent a lot of time discussing about key themes that are very hot right now, that are providing very nice trends, very tradable trends right now, that you may be willing to explore if you are looking to have a little bit of alpha in the markets right now overall. So that wraps up our entire video. So hopefully you guys enjoyed today's video. Once again, apologies for not being here the last few days. I will be back home in about a week and a half, so we will be returning to normal scheduled programming. But if you indeed enjoyed this video, consider dropping a like. Would appreciate it for the growth of the channel. I would appreciate if you consider subscribing to the channel as well. We do these as frequently as possible when I'm traveling, but I'm back home every single Monday to Friday. And last but not least, guys, if you have any questions, comments, feedback, or if you guys are looking at certain different opportunities, definitely want to hear from you guys in the comment section down below. I will be answering all your guys' comments either tonight or tomorrow. And that's it for me, guys. Obviously, if you want to interact with me in more real time and have access to all the companies that I'm trading, the long-term investments, the swing trades, the themes, discuss with me on a daily basis, because even though I may not be here on YouTube every day, I'm in our Discord every single day doing live streams, answering questions, talking about these themes, talking about various trade opportunities and trade ideas. So if you wanted to join us in the community of over 300 members, such as yourself, and you didn't want to trade the markets all by yourself, well, you can join us. The link to join us in the Discord is down below in the video description. So hopefully I get to see a few more of you guys in there soon, so we can talk everything about the markets, about options, about themes, about trade ideas, trade styles, long-term portfolios, and everything in between, guys. That's it for me. Take care. See you tomorrow after NVIDIA earnings. Peace.